Right then, settle down everyone, forget V8 engines, turbochargers for a moment. We're talking about something even more critical to keeping a machine running. Not a car, but a business. I'm talking about cash flow. Cash flow is the lifeblood of a business. Now, you might hear your teacher say, cash flow is the lifeblood of a business. Imagine a business is a high-performance supercar. Profit is how fast it can go on paper, its top speed. But cash is the actual petrol sloshing around in the tank. If that fuel gauge hits zero, you're not going anywhere. You could be making massive profits selling bespoke unicycles, but if all your customers promise to pay next month, you're in a spot of bother. Rent on your workshop, wages for your chief wheel tester. Electricity to power the kettle. They don't wait for next month. If you have no cash coming in, you can't pay those bills. Suddenly, your profitable business has sputtered to a halt. It's a classic rookie mistake. Physics will have its say. While mates brag about profit margins and revenue, you'll be the clever one who understands the real engine room, the rhythmic flow of money in and out. So buckle up, we're about to take a high-speed tour of cash flow management. Let's get under the bonnet and look at the moving parts. Cash flow is basically a race between money coming in and money going out. We call these cash inflows and cash outflows. Simple, right? Cash inflows are the lovely bits of money speeding into your bank account, revenue from sales. The main one is revenue, people handing over cash for your goods or services. Other inflows, loans from the bank, grants or selling an old delivery van, all cash arriving, ready to use. On the other side, you have cash outflows. Money loves to leave fast, paying invoices, rent, electricity, phone contracts, and wages, all those things that keep the lights on and wheels turning. Outflows are the wear and tear on your tires. Necessary, but manage carefully or you'll end up in the gravel. The goal of the cash flow Grand Prix is not just yearly profit. It's having enough cash to pay the outflows that are due right now. Timing is everything. You might have a huge sale next week, but bills due today. If you've only got £50, it's like knowing a fuel tanker's 10 minutes away, but your engine has already cut out. Tricks: ask for deposits, negotiate supplier terms, manage your credit terms. It's like getting a slipstream to conserve fuel. Getting cash flow timing right is an art. Orchestration and rhythm. Never let your eyes off that fuel gauge. Master this, and you'll take the checkered flag while rivals are stuck in the pits. Now we've covered the flow, let's talk about the pool of cash you have at any one time, working capital. Working capital is the actual fuel in the tank, money for day-to-day running. The formula is simple: current assets minus current liabilities. Current assets, cash in the bank, money owed by customers, debtors, and your stock. Current liabilities are bills chasing you, money you owe suppliers, utility bills, any bank overdraft. These are the corners you must navigate right now. Working capital is what's left when you take available cash and subtract bills due very soon. A positive working capital gives you a buffer, a spare tire in the boot. Negative: Hammond, we have a problem. If a supplier offers a huge discount for immediate cash, healthy working capital lets you jump and save a fortune. If you're running on fumes, you watch that chance drive off into the sunset. It's not one size fits all. A hot dog stand needs little. Bespoke furniture needs a much bigger fuel tank. Have enough to cover bills and surprises, but not so much that cash sits idle doing nothing. It's a balancing act, like taking the perfect racing line. Healthy working capital equals sign flexibility. It's your safety net and lets you pounce on opportunities. Keep it healthy. Exam question incoming. Explain current assets minus current liabilities. Simple and memorable. Okay, we know we need to manage cash, but how without a crystal ball? Well, businesses have the next best thing: a cash flow forecast. It's a month-by-month prediction of money in and out. Your financial sat-nav. Starts with the opening balance, then list expected inflows, so sales, loans, other income. Add total inflows. Below that, list outflows, wages, rent, materials, utilities. Add to get total outflows. Subtract outflows from inflows. That gives net cash flow. Positive or negative, it flows into the closing balance. Example: opening £1,000 plus net plus pound 500 equals sign, closing £1,500. That closing balance becomes next month's opening balance. Repeat to map your future cash. Watch the closing balance. Seeing a shortfall months ahead gives you options now. Options: arrange overdraft, boost sales with marketing, chase customers for payments, or delay big purchases. The forecast lets you act early. If the closing balance hits zero, what happens? You can't pay bills. Suppliers stop supplying, materials run out, production halts, no sales, no cash. You can't pay staff. Teams demotivate, your best people leave, and you're left with a skeleton crew. Being illiquid is stressful. Equipment might be sold, you could become insolvent and forced to cease trading. Cash is king. Remember, understand inflows versus outflows. Keep working capital healthy. Use forecasts to spot trouble early. Do that and you'll cruise past the finish line with a full tank and a grin. Now, who wants to talk about V12s?